Last part of analyzing the effect of the tax on this market will be a welfare analysis. We'll calculate consumer and producer surplus after the tax, as well as government revenue and deadweight loss. So here, if I'm looking at the graph, I want to identify my areas of consumer surplus, which will be above the price for consumers and below the demand curve. Producer surplus will be the area below the price for the firms and above the original supply curve. So we have consumer surplus and producer surplus here. And you'll notice a few different missing areas, which we will label in just a moment. So let's go ahead and calculate first consumer surplus and producer surplus. 1/2 500 minus 275 times 450. And you can see that both consumer and producer surplus here are decreasing because the quantity has gone down and the price for consumers has gone up while the price for the firms has gone down. So nothing good is happening here for either consumers or producers. And you plug that into your calculator, you'll see that consumers have a surplus of 50,625, and then producers have a surplus of 30,375. And adding together, we get consumer plus producer surplus, but that's not quite equal to total surplus in this case because there's one value that we're missing, and that is government revenue. So someone else now benefits from sale in this market, right? From transactions in this market. The consumer gets an apple, the producer gets some money, and the government gets some money too. So we need to take into account government revenue when we're calculating total surplus. Let's think a little bit about how much revenue the government earns from sales in this market. Government revenue is equal to the amount of the tax, because we have an excise tax, we pay, say, 50 cents per apple. The government will earn 50 cents for every apple sold. So that would be the amount of the tax times the new quantity that's sold in the market. So I can calculate that mathematically by taking the tax, in this case $40, times the new quantity of sales, and I get $18,000 in government revenue. But I can also represent that on the graph, okay, by looking here at this rectangle between consumer and producer surplus. You can see the height of the rectangle, that's the tax wedge, right? That distance there, that's the $40 here in between 275 and 235. And the length of the rectangle is the quantity that's being sold in the market. So when I multiply those two values together, I am going to get the amount of revenue that goes to the government. So this is the tax revenue here. So you can see from every transaction, part of the potential surplus from the consumer and the producer, right? The difference between the willingness to pay of the consumer and the cost of production for the producer, part of that now is captured by the government through the tax. All right, so now we've filled in our area of total surplus. So total surplus here would be 81 plus 18,000, and that gives me $99,000. We can compare that to our surplus from the original equilibrium with no tax. So you can see here that was $100,000, and I see that surplus has decreased by $1,000. So my deadweight loss, I know my deadweight loss here equal to the difference between my total surplus, which gives me $1,000. But normally I won't have you calculating surplus before the tax and surplus after the tax and taking the difference, and that's going to take you a lot longer to do. So what you want to be able to do is identify the deadweight loss triangle on the graph and then calculate the area of that triangle. So let's go back to the graph one more time. And remember that before the tax, this was our equilibrium point here. So total surplus was the area of the big triangle all the way out to a quantity of 500. Now, after the tax, of course, we have this restriction in trade. Deadweight loss usually results from some restriction of trade. And because these consumers who value the product more than the cost of producing it are not able to buy the product because of the tax, then our decline in surplus is equivalent to this area here. So this is our deadweight loss triangle. And you can see that the height of that triangle is equal to the tax, right? That's that $40 tax wedge there. And the width of the triangle is equal to the difference in the quantity traded. So I can calculate deadweight loss. So this is how you'll normally calculate deadweight loss. 1/2 times I've got 275 minus 235. That's the height of the triangle. And the width is 500 minus 450. So this is the amount of the tax. So I have 1/2 times the amount of the tax times the change in quantity. And again, if you go ahead and calculate that, right, you've got 1/2 times 40 times 50 is going to give you 1,000, the difference in total surplus due to the tax. So at the end of the day, we see that, you know, nobody likes taxes. Consumer surplus goes down, producer surplus goes down. Of course, the government gets some revenue that they can then spend on other programs, like we discussed in the last module, but the real cost of taxation is that deadweight loss. That's a loss in surplus to our society that results from the distortion of the market due to the tax.